Hello, everyone. Welcome to the Tim Booker channel. I wish you all an enjoyable listening experience. Today, the book I'm going to interpret for you is Courage to Act. In this book, Bernanke reflects on the 2007 subprime mortgage crisis and his specific actions in response to the crisis. It offers insights into the origins of the financial crisis and an understanding of global economic trends. This book provides an excellent perspective. Bernanke was born in 1953 and studied at Harvard University and the Massachusetts Institute of Technology. After earning his PhD from MIT, Bernanke began his teaching career and spent 17 years at Princeton University. In 2002, Bernanke was appointed as a member of the Federal Reserve Board by President George W. Bush. In 2006, following Alan Greenspan's retirement, Bernanke became the new chairman of the Federal Reserve, serving in that position until February 2014, a total of 8 years at the helm of the U.S. Central Bank. Shortly after Bernanke took over the Federal Reserve, the subprime mortgage crisis and the European sovereign debt crisis erupted, causing a global financial storm. The U.S. and European economies teetered on the brink of collapse. Bernanke led the Federal Reserve in actively intervening in the financial markets and was named Time magazine's Person of the Year for 2009. While Bernanke's actions to rescue the economy generated controversy, his role in addressing the subprime mortgage crisis was undeniable, and the U.S. did not experience a depression like the 1930s. From this perspective, if you want to gain a deep understanding of this significant historical event, Bernanke's memoir is unquestionably a must-read. Due to the unique position of the U.S. economy in the Federal Reserve, Bernanke's policies had a far-reaching impact not only on the United States but also on the global economy, especially his leadership in implementing quantitative easing policies. Although these policies have ended, their effects on the current and future world economy continue to evolve. To comprehend this process, one must return to the starting point of the policies, delve into Bernanke's economic thinking, and explore the contents of Courage to Act. The book contains approximately 560,000 words, and today, I will interpret its essential content in 3 parts. 1. Bernanke's economic ideas and policy recommendations. 2. How Bernanke's Federal Reserve responded to the financial crisis. 3. Reflections from Bernanke and various sectors of the United States on the financial crisis. Let's begin with the first part, Bernanke's economic ideas and policy recommendations. Among the various Federal Reserve chairpersons throughout history, Bernanke stands out as a unique figure. He transitioned from being the head of an economics department at a university to being directly nominated by President George W. Bush as a member of the Federal Reserve Board. After a brief period in 2 positions, he took over as the chairman of the Federal Reserve in early 2006, succeeding Alan Greenspan. Prior to this, he had virtually no political experience, making his ascent akin to a meteoric rise, going from a university professor to a high-ranking national official. Why did President Bush place such trust in Bernanke? This is closely tied to Bernanke's economic ideas and policy recommendations. Bernanke was influenced by the foundational work of Fisher in the field of new Keynesian economics. His academic focus centered on studying the Great Depression of the 1930s. Bernanke's grandmother had lived through the Great Depression and shared her experiences with the young Bernanke. She explained how children of factory workers went to school barefoot because their fathers had lost their jobs, and why they couldn't afford shoes anymore. This posed a seemingly inescapable cycle of problems. But the key question was why people didn't have money in the first place, which, Bernanke realized, was the crux of the matter. As he pursued his academic career, Bernanke came across the work of Friedman and Schwartz, particularly their book, A Monetary History of the United States. Friedman argued in the book that deflation was the primary cause of the Great Depression. This conclusion strongly resonated with Bernanke and dispelled his earlier perplexities. Deflation, in simple terms, means that money disappears from circulation. When there isn't enough money in circulation, it can't satisfy people's need to exchange goods. As a result, many goods go unsold, and people who want to buy them don't have the money. Building on Friedman's theory, Bernanke went further. He dissected the process of the Great Depression and economic crises, believing that they were processes of panic spreading and accelerating. Initially, it might be an isolated incident, a temporary shortage of funds in society, which rational individuals might view as a short-term fluctuation. However, some individuals start to worry, and this worry becomes contagious. Eventually, it plunges the entire society into panic. For instance, if a small bank is defrauded, a rational perspective would see it as a short-term loss. Still, some depositors might get worried about the bank's safety and decide to withdraw their money. When other depositors hear about the withdrawals, they join the queue as well. Ultimately, a random incident escalates into a full-blown bank run, and the small bank goes bankrupt. Bernanke believed that in an economic crisis, the financial system acts as an accelerator of panic, transmitting and amplifying panic between consumers, businesses, and the financial sector, eventually leading to a complete economic collapse. This is what is widely known as Bernanke's theory of the financial accelerator. Based on this theory, Bernanke proposed a new set of policy recommendations known as inflation targeting. This entails creating a well-defined environment of moderate inflation. The Federal Reserve publicly announced that it would set monetary policy to achieve an inflation rate of around 2% per year, ensuring that there is ample money in the market to prevent deflation and stimulate economic growth. When President Bush assumed office, it was during the bursting of the dot-com bubble, and the U.S. economy was struggling with sluggish growth and persistently high unemployment. It was an urgent time to find new ways to stimulate the economy. Upon the recommendation of economics professor Glenn Hubbard, Bernanke entered the realm of Washington economic decision-making. In his Oval Office, Bernanke's inflation-targeting concept greatly pleased President Bush. Therefore, regardless of Bernanke's lack of political experience, he was elevated to the position of chairman of the Federal Reserve. Once in office, Bernanke immediately began implementing inflation targeting and emphasized the transparency and institutionalization of the Federal Reserve's monetary policy. History, fortuitously, provided Bernanke with the perfect opportunity to validate his theories. In the summer of 2007, a sudden subprime mortgage crisis swept through Europe and the United States, casting a shadow reminiscent of the Great Depression. Bernanke took decisive action to prevent the financial accelerator from transmitting the crisis to the real economy, thereby avoiding a replay of the tragedies of the 1930s. In summary, Bernanke's economic ideas and policy recommendations can be summarized in 3 sentences. 1. A laissez-faire banking and financial system is susceptible to the impact of random events, turning into a financial accelerator that spreads and amplifies panic, resulting in deflation. 2. Deflation is a primary cause of a major depression. Therefore, when a crisis looms, proactive intervention in banking and financial institutions is necessary. 3. To prevent crises from driving economic downturns, it's essential to establish inflation expectations. Now let's move on to the second part, how Bernanke's Federal Reserve dealt with the financial crisis. The global financial storm that erupted in the summer of 2007 went through roughly 3 phases. Let's take a look at each stage and the targeted measures Bernanke took during each one. The first stage of the financial storm can be called the subprime crisis. The term subprime refers to subprime mortgages, which are housing mortgages provided by financial institutions to borrowers with low credit and income. Typically, when you apply for a mortgage to buy a house, you need to provide proof of income and financial statements. Banks also assess your credit history, including any outstanding debts. So why did U.S. financial institutions start giving mortgages to people with poor credit and low incomes? Weren't they concerned that borrowers might default on their loans? Well, this involves a financial innovation. To stimulate the real estate market, U.S. semi-official financial institutions like Fannie Mae and Freddie Mac started trading long-term mortgage contracts on the securities market. After issuing the loans, they would then sell the mortgage contracts to other financial institutions in the market. This reduced the risk for the initial lenders, making them eager to engage in this type of business. Consequently, lending standards gradually relaxed, and even applicants with poor repayment capacity were approved for mortgages. However, when these mortgage contracts were rated by credit rating agencies for trading on the securities market, they were classified as subprime due to the borrower's low income, giving rise to the term subprime. Initially, subprime mortgages were somewhat successful, benefiting various parties involved. Families with poor financial conditions could buy homes, lending institutions saw a significant increase in business, rating agencies earned substantial rating fees, and the financial market witnessed the emergence of a new category of investment products. The U.S. government also witnessed an influx of hot money, stimulating real estate investment, boosting various industries, and creating employment. It was a win-win situation for everyone. However, human nature is inherently greedy, and this mutually beneficial financial innovation gradually deviated from its original path under the temptations of greed. Lending standards plummeted, and the review process became increasingly lenient. To create more subprime loans, financial institutions devised various schemes, such as adjustable-rate mortgages and teaser-rate loans. What are adjustable-rate mortgages and teaser-rate loans? In simple terms, they offer low initial interest rates that gradually increase over time, creating a growing repayment burden. These loans attracted individuals who had no ability to repay in the first place, and they hastily signed home purchase contracts. In normal circumstances, you might wonder what would happen if these people couldn't repay their loans. However, the lending financial institutions weren't concerned because they planned to sell off the mortgage contracts they issued to the securities market. Nevertheless, borrowed money must eventually be repaid. As time passed, subprime and mortgage contracts without repayment capacity began to experience defaults and delinquencies. Since financial institutions bundled both strong and weak mortgage contracts together and sold them as packages, once subprime contracts defaulted, these asset packages also defaulted, resulting in a widespread toxic asset problem. This finally caught the attention of the Big Short investors, who began heavily shorting mortgage-backed securities. Shorting, in this context, means that when you believe a security is sure to decrease in value, you can borrow that security from an institution that holds it, immediately sell it on the market, and then buy it back later when it has indeed decreased in value, returning it to the institution and pocketing the difference. If many people short a security simultaneously, its price plummets rapidly. Institutions that had purchased these subprime assets suffered enormous losses. Eventually, the truth came to light. On August 9, 2007, BNP Paribas announced the suspension of all trading activities for 3 of its U.S. housing funds, realizing that they couldn't sell their holdings as investors rushed to redeem their investments. This marked the beginning of the subprime crisis, which quickly spread from Europe to the United States, causing substantial losses for many financial institutions in both regions. Major financial institutions deeply involved in subprime mortgages, such as Germany's IKB Deutsche Industriebank, the U.S. Federal Home Loan Mortgage Corporation, and the U.S. Federal National Mortgage Association, all faced bankruptcy. This formed the first wave of the subprime crisis. In response to this situation, Bernanke primarily employed 3 strategies. First, he played the role of a global central bank, providing financial assistance to European central banks to stabilize the financial situation. Second, he opened the discount window, allowing domestic banks and financial institutions to borrow funds openly. The discount window is a significant tool of the Federal Reserve's open market operations, directly providing loans to financial institutions. Before the crisis, the Federal Reserve typically provided overnight loans to commercial banks. After the crisis, Bernanke not only reduced the interest rate for discount window loans but also extended the loan term to 30 days, later extending it to 90 days, with the option for unlimited extensions until borrowers could repay. Third, as commodity prices were affected by the financial crisis and began to decline, the Federal Reserve immediately started reducing interest rates. In less than a year, it lowered the federal funds rate from 5.25% before the crisis to 0%. Unfortunately, Bernanke's 3-pronged approach was unable to quell the market panic. Major financial institutions continued to incur losses, and Wall Street firms were hit hard. As the crisis escalated further, the subprime crisis evolved into a financial storm. On December 20, 2007, Bear Stearns, the 5th largest investment bank on Wall Street, announced substantial losses related to its subprime business. This news triggered a massive redemption of funds by its investors, leading to a liquidity crisis. Because Wall Street financial institutions had entered into various asset swap contracts, where one prospered, all prospered, and where one suffered, all suffered. Consequently, major players in the financial industry became victims of the second wave of the financial storm, including Lehman Brothers, Merrill Lynch, Citigroup, and the world's largest insurance company, American International Group, AIG. The U.S. financial system teetered on the brink of collapse. In the second stage of the crisis, Bernanke's primary strategy was to leverage the immense financial resources of the Federal Reserve to directly inject capital into private institutions and rescue large, systemically important financial institutions. In Bernanke's theoretical framework, a large number of bank failures during a crisis would deepen the crisis and create a critical link to deflation. This was something he was determined to prevent, as he did not want a repeat of the tragic events of the 1930s. When Bear Stearns was on the verge of bankruptcy during the crisis, the Federal Reserve introduced a rescue model called lender of last resort. They chose one or two willing financial institutions, in this case JP Morgan Chase, and provided them with a $30 billion special loan to help them acquire Bear Stearns' entire equity and take on Bear Stearns' debt. During a congressional hearing, Bernanke explained that Wall Street investment banks were already interconnected through various financial transactions such as money market funds, forward contracts, and repurchase agreements. Allowing the fifth largest investment bank, Bear Stearns, to go bankrupt would undoubtedly have had a cascading effect, involving the remaining major financial giants and risking a complete shutdown of the U.S. financial system. Subsequently, the Federal Reserve used a similar, lender of last resort, model to support Bank of America's acquisition of Merrill Lynch and PNC Financial Services' acquisition of National City Corporation. The Federal Reserve had originally planned to support Bank of America and Barclays' acquisition of Lehman Brothers, but both banks withdrew from the deal. This left Lehman Brothers, ranked fourth on Wall Street, as the largest financial institution to collapse during the financial storm. One of the companies that benefited the most from the Federal Reserve's intervention was American International Group, AIG, an insurance company. AIG received over $180 billion in public funds, accounting for 10% of the total appropriations by Congress and the Federal Reserve. However, in March 2009, while the crisis was far from over, AIG controversially distributed $165 million in bonuses and allowances to its executives. This sparked a public outcry and ignited a heated debate about moral hazards. The debate surrounding the Federal Reserve's intervention policy extended beyond moral hazards. Some argued that it was the Fed's overzealous response that created new panic and provided fresh targets for short sellers. In response, Federal Reserve Governor Donald Cohn subtly cautioned Bernanke, "Our assistance actions have been too aggressive, and the market is speculating about what might be hidden behind them. We know, but we haven't disclosed it." Indeed, short sellers were closely monitoring the Federal Reserve's rescue actions for new prey. For instance, when Citigroup participated in the acquisition of Wachovia Bank in response to Bernanke's call, speculation arose that Citigroup might not have sufficient funds and was looking to secure Wachovia's $400 billion in retail deposits. As a result, Citigroup's short-term financing securities faced massive selling pressure. Citigroup also became a recipient of the Federal Reserve's assistance. This chain reaction persisted until October 3, 2008, when the U.S. Congress approved Treasury Secretary Henry Paulson's Troubled Asset Relief Program, TARP, a $700 billion plan to purchase distressed assets. This program essentially signaled to the market that any shortfalls would be filled. This was the turning point when short sellers began to feel that the tide had turned against them. The massive wave of concentrated selling of securities held by specific large financial institutions finally dissipated. This marked the end of the second stage of the crisis. Bernanke shifted his focus to address the third wave of the financial crisis. This wave primarily impacted the U.S. financial wholesale market, a unique phenomenon in the United States. After the Great Depression, the Federal Reserve Act stipulated that the federal government would only guarantee deposits up to $100,000 per account. Funds exceeding $100,000 flowed into the financial wholesale market, which differs from the financial retail market that directly absorbs deposits from customers. Out-of-balance sheet activities of banks, such as wealth management products and trust plans, often referred to as shadow banking, along with many non-bank financial institutions, congregated in the financial wholesale market to engage in investment and financing activities. The financial wholesale market played a crucial role in the U.S. real economy, as manufacturing companies like General Electric and Boeing issued commercial paper and corporate bonds here for both short-term and long-term financing. The subprime crisis severely shook the confidence of both investors and borrowers, and this lack of market confidence quickly led to a contraction in commercial paper trading activities. Not even the solid commercial paper of companies like General Electric could find buyers anymore. Small and medium-sized enterprises faced even greater difficulties in obtaining financing. If this situation persisted, it would directly impact manufacturing and consumer spending, leading to a genuine economic depression. To salvage the situation, Bernanke introduced two targeted mechanisms. One empowered the New York Federal Reserve Bank, a subsidiary of the Federal Reserve, to directly purchase commercial paper from the market, filling the gap left by the withdrawal of private funds and helping restore market confidence. The second involved the Federal Reserve providing guarantees to support financial institutions in issuing nearly 3 million auto loans, 1 million student loans, 900,000 small business loans, 150,000 corporate loans, and millions of credit card consumer loans. Bernanke's two mechanisms gradually restored the functionality of the U.S. financial wholesale market, and by May 2009, the U.S. financial system had returned to normal operations. So, we've covered the response policies the Federal Reserve implemented during the three stages of the financial storm. In a brief recap. In the first stage, the subprime crisis erupted, and financial institutions heavily involved in subprime business faced bankruptcy. The Federal Reserve used a combination of currency swaps, direct monetary injections, and interest rate cuts to boost market confidence and prevent panic from spreading. In the second stage, as the crisis deepened, major Wall Street investment banks came under pressure. The Federal Reserve decisively intervened to rescue too-big-to-fail financial institutions, preventing the overall collapse of the financial system. In the third stage, with market confidence lacking, the financial wholesale market experienced reduced trading activity. The Federal Reserve took proactive measures to restore the functionality of the financial wholesale market and guard against the spread of the financial crisis to the real economy. So, how have Bernanke's series of policies been evaluated by various parties? Let's take a look at how people assess the Federal Reserve's actions during the financial storm from the perspectives of Bernanke himself, the U.S. economic community, and the U.S. Congress. In Bernanke's view, two major factors triggered the crisis. First, Congress and Wall Street, driven by their own interests, intentionally allowed the housing bubble to inflate without intervention or regulation, ultimately allowing the subprime virus to spread unchecked. Second, the fragmented regulatory system was no longer suitable for the contemporary U.S. financial industry. For instance, the Federal Reserve could only regulate banking institutions, while insurance companies, investment banks, and other non-bank financial institutions engaged in mixed operations on a considerable scale. They created innovative financial derivatives and, to diversify risk, bound themselves closely together through mutual holdings of securities, bonds, and various derivatives, forming a susceptible system within the Western financial system. In Bernanke's perspective, this financial storm didn't plunge the real economy into a prolonged depression as the 1930s financial crisis did, thanks to the courageous actions of the Federal Reserve and himself in actively intervening in the markets. Bernanke's strategy to address the financial crisis is akin to treating a viral pandemic. First, energize the system by lowering interest rates, injecting liquidity, and preventing the economy from going into sudden shock. Next, use antibiotics on the inflamed vital organs to prevent them from deteriorating, which translates to providing funds to rescue the too-big-to-fail financial institutions. Finally, restore bodily functions by helping the financial wholesale market regain vitality, ensuring it continues to provide essential support to the real economy. However, unlike Bernanke's self-assured perspective, many in the U.S. economic community have questioned the actual effectiveness of the Federal Reserve's bailout measures. They argue that while Bear Stearns was saved, it didn't prevent the crisis from continuing to spread. The collapse of Lehman Brothers, they claim, didn't exacerbate the crisis, demonstrating that the mechanisms driving this crisis were different from those of the 1930s. This crisis didn't stem from collective panic but rather from large hedge funds that had prepared for it, possessed strong analytical capabilities, and were deeply involved in next-generation financial institutions. Another category of criticism centers on the idea that Bernanke's rescue of too-big-to-fail financial institutions disrupted the market's natural mechanism for capitalistic risk-taking. They argue that capitalism without bankruptcy is like Christianity without hell. Institutions involved in the next crisis won't be deterred, fostering moral hazards in the financial industry in the long run. The broader debate revolves around how to improve the regulatory system to prevent another financial crisis. After the financial storm, the federal government and Congress were determined to comprehensively reform the U.S. financial regulatory system. The Dodd-Frank Wall Street Reform and Consumer Protection Act, led by Senate Banking Committee Chairman Dodd and House Financial Services Committee Chairman Frank, was enacted. This redesigned U.S. financial regulatory system aimed to address the issue of regulatory fragmentation. It established the top-level regulatory architecture, the Financial Stability Oversight Council, responsible for monitoring and addressing systemic risks threatening national financial stability. Additionally, it created the Consumer Financial Protection Bureau to oversee financial institutions providing consumer financial products and services, including credit cards and mortgages. The previously unregulated over-the-counter derivatives market was also brought under regulatory oversight. The Federal Reserve's regulatory purview expanded as well, with bank holding companies, non-bank financial companies, and large insurance companies with assets exceeding $500 billion all falling under its supervision. However, the law stripped the Federal Reserve of its authority to bail out private financial institutions. In the future, too big to fail financial institutions, if they fail in their operations, will no longer be rescued by the Federal Reserve. The law also imposed requirements for transparency in the Federal Reserve's discount window operations, strengthening congressional oversight of the Federal Reserve. The Dodd-Frank Act's interference with the Federal Reserve's independence and limits on its powers can be seen as an authoritative evaluation of Bernank's series of rescue measures based on U.S. public sentiment. Finally, let's briefly discuss two extension issues closely related to the current economic situation in the United States. The first one is quantitative easing, which is the most important policy introduced by the Federal Reserve after the financial crisis. To stimulate the economy and boost employment, the Federal Reserve implemented 4 rounds of quantitative easing over 6 years. By the time Bernanke left office in 2014, the U.S. employment rate had finally approached pre-crisis levels. From an international perspective, quantitative easing also played a crucial role in maintaining global market confidence. When the euro was adversely affected by the European sovereign debt crisis, leading to a sharp drop in the value of the euro against the dollar, it was thanks to the Federal Reserve's massive release of dollars into the market that the euro's decline was halted. Otherwise, the European financial turmoil would have intensified. However, after 4 rounds of quantitative easing, the Federal Reserve's balance sheet expanded from $900 billion before the crisis to 5 times that size, reaching $4.5 trillion, equivalent to a quarter of the entire U.S. GDP. Fortunately, the massive funds injected by the Federal Reserve into commercial banks weren't immediately lent out as loans, resulting in total deposits in the U.S. financial system exceeding loans by $2.4 trillion. Analysts were concerned that if this money were to flood the market, severe inflation would become inevitable. When Janet Yellen took over as chair of the Federal Reserve after Bernanke, her top priority was to exit quantitative easing and normalize monetary policy. Yellen assumed office in February 2014, and just 8 months later, she announced the end of quantitative easing. The second extension issue we'd like to discuss is Bernanke's adherence to New Keynesianism, which involves using loose monetary policy to stimulate economic growth. What has been the actual impact of this policy? This question becomes particularly meaningful in the current global trend of deleveraging interdependence. Mainstream U.S. economists who adhere to free market theory generally share a fundamental view: the prosperity created by loose monetary policy is not sustainable. Lawrence Summers, often considered the doyen of contemporary U.S. economics, once put forth an argument that the long-term stagnation of the U.S. economy resulted not just from the bursting of the dot-com bubble and the real estate bubble but, more fundamentally, from slow labor force expansion and productivity growth. The loss of competitiveness of low-skilled labor in the global division of labor contributed to these issues, and these are not problems that the Federal Reserve can solve. Quantitative easing, often seen as a helicopter money approach, helped maintain the income and profit levels of banks, fund companies, and large corporations but did not significantly improve the living standards of the American middle class and industrial workers. After President Trump, who campaigned on the promise to revitalize American manufacturing, was elected, he nominated Jerome Powell as the new chair of the Federal Reserve. Powell is a typical hawk who firmly supports a prudent monetary policy and opposes excessive money supply. Just as Congress approved his appointment, the U.S. stock market immediately gave him a challenging welcome. The Dow Jones Index experienced consecutive daily drops of over 1,000 points. Nevertheless, Powell stated that he would adhere to interest rate hikes without wavering because real economic growth relies on innovation and hard work. The Federal Reserve and loose monetary policy cannot solve all problems. Well, this book concludes here, and congratulations on completing another book. Thank you for your support and attention. Please subscribe to the Tim Booker channel, like, and share this valuable knowledge with your friends. Let's combine wisdom with practice to achieve our financial goals and create a better future together. Thank you, and goodbye.